You're sitting there watching Robinhood stock swing wildly between $63 and $153 this year, wondering if this is the next big fintech play or just another meme stock waiting to crash. You've seen the app revolutionize trading, but you've also heard the horror stories about outages and regulatory drama. Here's what most people miss: thinking about Robinhood as just a trading app isn't wrong, it's catastrophically incomplete. I've spent years tracking what separates winning fintech investments from the losers, and here's my read on Robinhood's potential upside. The company essentially democratized stock trading, turning what used to be a $10 per trade barrier into free transactions for millions of young investors. At $92 today, we're looking at a company that's sitting on a massive user base in the sweet spot demographic, millennials and Gen Z, who are just starting their wealth-building journey. The real kicker? Most of these users are still in their accumulation phase, meaning their account values and trading frequency should naturally grow over the next decade as their incomes rise. But the growth story everyone's missing is the one that could change everything about this stock. Here's what caught my attention: Robinhood doesn't just make money when people trade, they make money when people hold assets on their platform. Payment for order flow gets all the headlines, but the real long-term value is in the growing assets under management and the financial services they can layer on top. Think about it: once someone has their stocks, crypto, and cash sitting in Robinhood, adding lending, credit cards, or even retirement accounts becomes a natural expansion. The company is essentially building the financial operating system for an entire generation. What's fascinating is how this positions them against traditional brokers who are still trying to figure out mobile-first investing. However, there's a massive risk that could derail this entire thesis. Here's my biggest concern with Robinhood stock: regulatory risk isn't just a headwind, it's an existential threat to their core business model. Payment for order flow, which has been a huge revenue driver, is constantly under scrutiny from regulators who argue it creates conflicts of interest. We've already seen the company pay massive fines for past issues, and there's always the possibility that their main revenue source could be restricted or eliminated entirely. On top of that, every market crash or trading outage becomes a PR nightmare that regulators love to investigate. The recent 17% drop over the past month shows how quickly sentiment can shift when investors get nervous about the regulatory environment. But here's what the smart money is actually doing with this uncertainty. Here's where it gets interesting: when I look at the institutional ownership data for Robinhood, there's a notable absence of the big-name investors we typically track. No major 13F filings from the usual suspects, no prominent fund managers making headlines with massive positions. This could mean one of two things: either the smart money sees risks that retail investors are missing, or this stock is flying under the radar of institutional investors who are still focused on traditional financial companies. The lack of institutional coverage actually creates an opportunity. Less competition from sophisticated investors means retail investors who do their homework might be able to spot value before the big money piles in. What I'm watching closely is whether this changes as the company matures. Let me walk you through what the price action is telling us about market sentiment. Trading at $92, we're sitting roughly in the middle of that $63 to $153 52-week range, but that recent 17% monthly decline is the key signal I'm focused on. This isn't random volatility, this is the market repricing the stock based on either earnings disappointment, regulatory concerns, or broader fintech sector weakness. The fact that we're well off the highs suggests the initial euphoria around the stock has cooled, but we're also not in panic selling territory near the lows. For momentum investors, this middle ground position is actually the hardest to read because it could break either direction depending on the next catalyst. The real question is what data points will determine which way this breaks. Here's my honest assessment of Robinhood stock right now. This is a company with massive long-term potential trading in a high-risk, high-reward zone. The bull case for capturing an entire generation of investors is compelling, but the regulatory overhang and business model uncertainty make this unsuitable for conservative portfolios. If I were building a case for Robinhood, I'd want to see three things: sustained user growth beyond just market euphoria periods, successful diversification of revenue streams beyond payment for order flow, and evidence that they can maintain their competitive moat as traditional brokers improve their mobile offerings. The case against is equally clear. Regulatory changes could crater their main revenue source overnight, and competition in fintech is brutal with low switching costs for users. Look, I can't tell you whether to buy or sell Robinhood stock. That's a decision only you can make based on your risk tolerance and investment timeline. What I can tell you is that this company sits at the intersection of some of the biggest trends in finance, for better and worse. If you want the complete data breakdown, including real-time institutional tracking and technical analysis tools, head over to nexusaicalls.com. Remember, successful investing isn't about finding the perfect stock, it's about understanding exactly what you're buying and why. Do your own research, and never invest more than you can afford to lose.